Hello, Bitcoiners. Welcome back to another edition of your Bitcoin Economic Calendar. I'm Mauricio Di Bartolomeo, co-founder of Ledin, and as with every Tuesday, we bring you the news and analysis you need to start the week off right in Bitcoin. Today is Tuesday, December 21st, and we have a very special episode for you this week. In today's issue, we're going to start by talking about the world's first Bitcoin mortgage, which we introduced last week alongside our Series B announcement. The demand and the response so far has surpassed our expectations. We're going to break down how the product works and more details on our Series B announcement in today's issue. In addition to that, we're also going to talk about why the United States or the Fed is rushing to raise interest rates while China is parallel to that lowering their interest rates. We're going to break down why the difference. And lastly, we're going to touch on the DeFi index, which has dropped now for 6 consecutive weeks. So grab your coffees, everybody. It's going to be a great one. And starting as we usually do with Bitcoin, just putting in a Bitcoin chart here. We can see that price action has remained quite volatile during the holiday season, driven in part by a fast-moving macroeconomic environment and thin trading volumes, as we can see here from the volume charts. Even though the moves have been somewhat meaningful, the volumes traded are well below those of May and earlier in the year. To speak about the volatile macroeconomic environment, just last week, the United States announced, or the Fed announced, that it would be doubling the pace of its tapering process. We had mentioned that in our previous issue, as if the Fed did happen to accelerate, it could bring pressure down in the markets. We basically have seen that the Fed very much decidedly says it wants interest rates to rise faster. And at the same time, in another headline that came out this week, we saw that the Chinese central bank actually lowered their benchmark interest rate. We're going to break that down in more detail in our S&P section, but we're going to talk a little bit more about the US Treasury bonds here. As we've been covering here for months now, there has been a positive correlation between the yield on the 10-year US bond and Bitcoin over the last year. And to highlight that correlation, we're just going to compare it here to this chart. And as you can see here at the beginning of the year, this is December 21st. Here's the January. Here's the first bar in January. But essentially, we can see that the yield on the 10-year note is essentially moving in tandem with prices of Bitcoin, or they've had a quite positive correlation throughout 2021 so far. One reason both Bitcoin and the yield on the 10-year note are showing a correlated price relationship could be the fact that they are both great barometers for future and current inflation. So by doubling the speed of its tapering efforts, the Fed is trying to get the yield on the 10-year note, this orange line, to move higher over the next few months. If this correlation remains, this means that Bitcoin could benefit from some tailwinds during that time. Looking at the markets, and here, just given the recent price move, we forgot to mention the price action. So Bitcoin actually closed last week down 6.82% at 46,704. So far this week, Monday and Tuesday, in the two trading sessions so far this week, it's up 4.39%. It's currently trading at around $48,753. Given this recent uptick in both the price of Bitcoin and the yield on the 10-year note, as we see, there has been some interesting shifts in some of the derivative products on the back end. And one such example is these funding rates for both Deribit and FTX. And we see here, just highlighting the FTX, this is the red line is the Deribit perpetual swap funding rate. Looking at these perpetual swap funding rates, we see that they've actually spiked to their highest level in the last month, which means that some investors are betting on a changing of the tides in the days to come. Again, these perpetual swap funding rates tend to be or can act as good short-term price indicators because it represents where the positions with a lot of leverage are being entered into. And so what this means is that while it doesn't necessarily mean that there's going to be a sustained run up in prices, it means that currently investors are bullish as far as their positioning on the perpetual swaps. Elsewhere, outside of the perpetual swaps, if we look at the options flow for today, I'm just going to pop that up here. It's taking a little bit longer than usual to find our options flow this morning. Here we go. Oh. There we go. So looking at the options flow here, we're seeing that there is a larger number of put sells than put buys, which means more investors are looking to sell downside protection than to buy downside protection. And there's been more call buys than call sells, meaning that more investors are looking for upside than investors are selling upside. So both of these positionings are consistent with what we're seeing in the perpetual swap funding rates, which means that in today's price action, investors seem to be positioning themselves decidedly bullish. So interesting to note. As we mentioned on the headline or during the intro, our company Ledin also made headlines last week as we announced our most recent round of financing along with the world's first Bitcoin-backed mortgage product. And that is something that we are incredibly excited about. Here's some of the headlines that came out. This one in particular is from Yogita at the Block. And the 70 million financing round was led by Dan Tapiro's 10T and included participation from our existing venture investors such as Coinbase Ventures, Alan Howard, Parify Capital, White Star Capital, and more. And we are very thankful for our clients for their continued support, as well as our investors for their continued support and believe in our mission. Proceeds from this round will be used to finance our growing lending business and to launch our Bitcoin-backed product, our Bitcoin mortgage product, which allows Bitcoiners to purchase real estate using their Bitcoin. The demand for the product has so far surpassed our expectations, and we are excited to bring this product to market in Canada and the US in 2022. You can learn more about our Bitcoin mortgage product at mortgage.ledin.io, and this is the website that we have on your screen right now. There will be a link to it in the blog so that you can learn more and sign up if you so choose. More on Bitcoin in our What's Ahead section. Switching gears to the S&P 500, we see that equity markets and central banks around the world continue reacting to a fast-moving macroeconomic backdrop, and volumes and price action remains quite volatile across the board. The most recent strain of the virus has resurfaced concerns of lockdowns and strict restrictions in some countries. And supply chain concerns have again resurfaced across the globe. The US Federal Reserve is trying to get ahead of runaway inflation, and last week it announced that it would be doubling the pace of its bond tapering efforts. This is the headline that's around that. It came out Wednesday after the FOMC meeting, as we highlighted. And essentially what it says is that it not only sees itself doubling the speed of its tapering efforts, but it also signals that it sees 3 potential rate hikes for next year. Now, a rate hike refers to the overnight borrowing rate. That is the shortest type of borrowing maturity that the Fed can set a price for. This benchmark rate hikes typically feed into the later maturity bonds as well. Equity markets have reacted quickly to the Fed's announcement, as we can see here with the S&P dropped 1.98% last week. This week it was actually quite down significantly, but we're seeing that it has recovered so far this week, or in today's session, has recovered from some of yesterday's losses. The NASDAQ and the Dow Jones, if we see how they reacted, we see that the NASDAQ last week dropped 3.25% in a week. And looking at the Dow Jones, we see that it also dropped 1.68% last week. All of them seem to be recovering some ground so far into today's trading session, into this week. But the canary in the coal mine for US indices might be the Russell 2000, which is this index that tracks small cap stocks, and we've been tracking. It's been range bound since essentially March of this year, and it's right now threatening or looking like it's going to break this long-term support throughout this channel that is held since essentially, earlier this year. It's been in these levels since January of this year. So if this happens, if this breaks down lower from this support level here, that's at the sort of 2158 mark, it's likely that it is going to try to find some support at a later point or a lower point closer to that 2000 mark. Again, so we'll continue to monitor this as the Russell 2000 we see as a canary in the coal mine, or a leading indicator for what will be happening to middle America and the indices of the larger indices as well. So switching back to these supply chain concerns that we highlighted, perhaps the most extreme example of the supply chain pain is what is happening in energy prices in Europe. And this is a headline that we have from Newsweek last week, stating that Europe's energy crisis just got even worse. To break down what's been happening, Europe has essentially been experiencing a trifecta of woes around energy prices. It's faced low wind speeds for the renewable production facilities, it's facing nuclear shortages in France for their reactors, and Russia is limiting the flow of natural gas into Germany. This is all combined to cause energy prices to soar across all of Europe, which has also led to the producer price index in Europe to spike into its highest levels since the 1980s. And this is that chart that we're highlighting from Bloomberg, essentially showing how much the producer price indexes have shot up in Germany. And as you can see, there's a correlation again between the producer price index and the consumer price index. So it is very likely that there continues to be upward pressure in consumer price level prices in Europe for the months to come. To put this problem into perspective, for context, Europe's historical electricity rates have been around 2 times what the rates paid in North America. Given the current market conditions, energy costs in Europe are about 6 times more than what they are in North America. So it's a big hit into basically anyone's profit or line, because everybody has to pay for energy, regardless if you're a business or individual. So as we mentioned, producer price indexes tend to act as leading indicators to consumer price indexes, which means more inflation could be ahead for Europe in the months to come. Now, switching out of Europe and into China, we see the headlines that we discussed also at the intro, which basically says that the Chinese government is cutting their interest rates for the first time in 20 months. And this is happening parallel to basically the US and other economies threatening their economies, saying that they're going to have to let interest rates rise. So some economies are looking to rise. Some economies like China are looking to drop their interest rates. And this is interesting because in the US is trying to deal with a potentially overheating economy. China is having to deal with the exact opposite. The lack of economic stimulus during the pandemic, because they did not inject as much stimulus, nearly as much stimulus as the other economies. The troubles that it has been facing in the real estate market, as we've been covering here through the Evergrande situation, and then the crackdown into their equity markets and some of their companies has essentially put a lot of pressure in their stock markets. And this is all combined and led to their economy slowing down, which has forced them to cut their benchmark interest rate for the first time in 20 months. If we look at the MSCI China index, which tracks some of the top companies in China, we see that if we go to essentially the start of this year, if we see where this index is year to date, we see that it's actually down almost 26% year to date. So there may be more action in China to try to make these markets recover and prevent their economy from falling into a recession. We might see the Chinese central bank get more active in the weeks and months to come. Moving over to gold, we see that gold prices actually finally caught a bid last week, with prices rising 87 basis points to $1,797 per ounce. Now, interestingly, gold prices reacted favorably during the week when the Fed announced that it would be letting their interest rates rise much faster. This is unexpected, as rising interest rates typically improve the real return of US Treasury bonds, which gold is negatively correlated with. So essentially, as the real return of Treasury bonds gets better, we would expect gold to fall under pressure. But in fact, we see it catch a bid in this backdrop. In addition, this move in gold also comes despite another big rally week for the US dollar index, which, as we know, also acts as a headwind for gold prices. So this price action is very interesting, as typically both of the things that we saw happen last week are headwinds for gold, but in fact, gold seems to have caught a bid on the back of rising bond yields and a stronger dollar. So investors could be signaling that even with these new renewed efforts, the Fed is still behind or well behind inflation. Inflation right now, just as a refresher, is around 6.8%. The yield on the 10-year note, just to give you an example, is 1.48%. So we're still way off the mark here. Moving over to our DeFi analysis, we see that the DeFi index has now dropped for 6 consecutive weeks. And in that time, it is down so far essentially 36% during those 6 weeks. It's pretty a meaningful drop. So as we've seen, layer 2 tokens continue to remain under pressure. These are the likes of Comp, Aave, Uniswap, while layer 1 protocol assets like Ethereum, Bitcoin, and Solana continue to show more relative strength. As we've covered in several issues in the past, this trend may continue as investors continue to challenge this concept of value accrual to the tokens, but it is clear that there are many projects being built on top of these layer 1 protocols, so there is some value accruing to these layer 1 protocols. And so again, this trend of stronger L1 performance over L2 tokens may continue based on these facts. And as we mentioned in previous issues, the market continues to learn what is valuable and what isn't. Checking in on the NFT world, last week we saw 2 very interesting headlines. First, Bitwise, here's the Bitwise headline. Bitwise released an NFT index fund which lists the top NFT assets, and it is available only to accredited investors. Interesting here, just for your reference, to show some of the breakdown of what they deem the top NFT projects. The ones on the list and the highest weighted ones, the 3 highest weighted ones are CryptoPunks, Bored Ape Yacht Clubs, and Mutant Ape Yacht Club. These would be the first 2 actually make up more than 60% of the fund. So interesting to see the weight average of some of these contributors. The news, the Bitwise announcement speaks to the growing demand from investors to have an exposure to this space. Elsewhere in the NFT world, we saw that Shopify announced that it would be allowing some content creators to mint and sell NFTs through the platform. Somewhat strangely, the announcement didn't come directly from Shopify. It came from Shopify's CEO, Toby, in his Twitter account. And this Input Mag made reference to that fact. We will continue to track the price performance of the Bitwise NFT index as a reference of market sentiment on the NFT space. And now to our Bitcoin mining difficulty commentary. Not much has changed on this front. The next difficulty adjustment is scheduled for this coming Saturday and should bring difficulty down a touch to 23.89 terahashes. We're still very close to that 25 terahash all-time high. Checking in on the mempool, we see here that transaction times and costs remain optimal. We have seen some little spikes throughout the last 2 weeks or so, but they're very quickly absorbed back. And transaction, as we mentioned, times and costs remain optimal here. And as always, we wrap up with what's ahead for the week. It is a short trading week due to the Christmas holiday on Friday for U.S. equity markets. And given thin volumes and volatile macroeconomic conditions, it is likely that markets can remain volatile until the first or second week of January, when more investors return to their desks and volumes trend up. This week, we get a read of inflation data and the housing market in the US, and we may get more headlines out of the European energy crisis and the Chinese economic slump that we covered in today's issue. There are also growing concerns over potential restrictions stemming from the new strain of the virus. So all of these could act as potentially mostly negative headlines for equities and risk assets in general. And this trend could continue as investors could be looking to protect some of their profits to end the year. The US equity markets have had a tremendous performance for the year. So has Bitcoin and a lot of digital assets. So some investors may be looking at the end of the year and trying to exercise caution and collect or crystallize some of those built up profits. A great example of this sort of risk-off mood that we're seeing is what we're seeing as far as price action on the stock of GameStop, which was the meme video game retailer, the darling, earlier this year. It is down 32.5% over the last 4 weeks. So important just to keep an eye here. Investors might be looking at the end of the year with caution. So, as always, we wrap up with a summary of the economic data and earnings reports that are up ahead this week. So tomorrow, Wednesday, 10 a.m., we get existing home sales in the US. The expectation here is for 6.5 million homes to be sold for the month of November, and the number could be expected to rise in the months ahead as the Fed is now rushing to raise interest rates, which people could perceive as more expensive mortgages. So they're just going to try to buy them while rates remain low. On Thursday at 8:30 a.m. Eastern, we get core inflation, personal consumption expenditures index in the US, and that's essentially a big read of inflation for the Fed because the PCE, the personal consumption expenditures index, is actually the Fed, one of the Fed's darlings, and it tracks it very closely. 10 a.m. Eastern Thursday, we get 5-year inflation expectations. The projection here is for a 3% inflation expectation for 5 years. Keep that in mind because the yield on the 10-year note is 1.48%. So that means that note is projected to be underwater for 5 years for sure, or not for sure, but that's what investors are. That's the outlook that most investors have. Also on Thursday at 10 a.m., we get new home sales in the U.S. This number is projected to increase to 766,000 homes from 745,000 homes in October. So a 20,000 home increase for the month of November. Again, for similar reasons, as mortgages look to get more expensive, it is likely that the numbers for sales and prices of U.S. properties continue to uptick as people rush to get their cheap mortgages before the rate goes up. So that wraps up the end of the show for today. It's been a big week. If you have any questions, any feedback, any comments, we welcome you to drop them in the comments section, and we'd look to incorporate your feedback and comments into the next issue. If you enjoyed the show, if you learned something today, I welcome you to like it, share it with your friends, and subscribe to our channel. If you don't yet have a Ledn account, I welcome you to check out ledn.io and learn how you can start earning up to 9.5% APY on your USDC and up to 6.25% on your first half of Bitcoin. We also have the best rates on Bitcoin-backed loans if you need financing and don't want to sell your stack. And now we have the world's first Bitcoin mortgage, which allows you to buy a home as big as your stack. You can learn more information about all of our products at ledn.io. Thank you, everybody. Have a wonderful week. Merry Christmas and happy holidays for you celebrating, and see you next week.